Most people throw away $50,000 every single year on tax mistakes they do not even know they are making. $50,000? That is enough to buy a brand new car, take a year-long vacation, or build a 6-month emergency fund. But here is what breaks my heart about this number. It is completely preventable. I know taxes feel overwhelming, forms, numbers, deadlines, and rules that change every year. The IRS makes it complicated on purpose so you stay confused and leave money on the table. But in this video, I am going to show you 7 tax habits that are keeping you poor, and more importantly, exactly how to break free from them. Some of these will save you thousands this year alone, others will change your entire financial trajectory. Let us go. Let me start with the fundamental problem. I call it the tax tail wagging the dog. Here is how this usually works. You hear about some tax strategy or deduction. Maybe it is from a friend, maybe from a YouTube video, maybe from your uncle who owns a business, and they say, wow, I saved $30,000 in taxes this year. And you think, wow, that sounds amazing, I need to do that too. But here is what nobody tells you. They probably spent $100,000 to save $30,000. That means they are $100,000 poorer, not $30,000 richer. The math does not lie. If you spend $1 to save 37 cents, you have lost 63 cents. Yet millions of people do this every single day. They buy things they do not need. They make investments that do not make sense. They all for one reason, a tax deduction. This is the meta mistake that enables all the others. And if you only remember one thing from this video, remember this: never let the tax tail wag the financial dog. Now let us talk about the first real habit that is keeping you poor, and this one is huge. Most people do not understand the difference between a deduction and actual money saved. Here is the problem. Your brain sees the word deduction and thinks free money. But that is not how it works at all. Look, I get it. When you are filing your taxes and you see a field that says deduct medical expenses or deduct business expenses, your brain is like, oh great, that reduces my taxes. And technically, yes, it does reduce your taxes, but it does not reduce your costs. Here is the real math. Let us say you are in the 24% tax bracket. You take a $10,000 deduction. How much do you actually save? 24% of $10,000. That is $2,400. $2,400. But you spent $10,000 to get that deduction. That means you lost $7,600. This is where most people make their critical mistake. They think a deduction is free. It is not. A deduction only saves you taxes on that amount. It does not refund what you spent. Now here is the key insight that wealthy people understand. They only take deductions on things they would buy anyway. The tax savings is the cherry on top, not the driver of the decision. This mental shift alone will save you thousands of dollars. Mistake number 2 is making terrible investments just to get a tax break. Picture this scenario. It is December 30th. You have had a great year, you are sitting on extra cash, and your accountant calls and says, we need to reduce your taxable income. So they suggest buying a commercial property or an expensive vehicle or some other asset. And you are thinking, great, I get to reduce my taxes and get an asset. But wait, did you actually want that property? Do you actually need that vehicle? Or are you only buying it because it reduces your tax bill? Here is the honest truth. If you would not buy it with your personal money, without the tax benefit, you should not buy it. I have seen so many people purchase $100,000 vehicles, terrible real estate deals, business equipment they never use, all for a tax deduction, and then they lose money year after year. The IRS calls this the ordinary and necessary test. Your deduction has to be ordinary for your business and necessary for your operations. A purchase you would not otherwise make fails this test. And even worse, the IRS knows this. They audit people who make these kinds of suspicious, last-minute purchases all the time. So here is what you do instead. Make your business decision first, based on what makes sense for your actual business. Then take the tax benefit as a bonus. Never the other way around. Now let us talk about mistake number 3, and this one affects almost every single person who has a job. You are not actually paying attention to your tax bracket. I know that sounds boring. Tax brackets sound like something that only accountants care about. But your tax bracket is literally determining how much of your wealth is leaving your pocket every single year. So let me explain how this actually works. The US has a progressive tax system. That means the more you earn, the higher percentage you pay. But here's the crucial part that most people miss. You do not pay one rate on all your income. You pay different rates on different portions. So let me give you a real example. Pretend you are married filing jointly and you earn $120,000 in 2026. You do not pay 22% on all $120,000. Here's what actually happens. The first $26,900 gets taxed at 10%. That is $2,690. The next $14,000 gets taxed at 12%. That is $1,680. And your highest income from $120,000 to $113,700 gets taxed at 22%. That is $1,660. So your total taxes on $120,000 is about $6,000, not 22% of the whole amount. Now here is why this matters for the habits that keep you poor. When you are considering whether to take a deduction, what matters is your marginal rate. Your marginal rate is the rate you pay on your last dollar of income. In this example, it is 22%. So if you have a $10,000 deduction and you are in that 22% marginal bracket, you save $2,200 in taxes. But if you are in a higher bracket, the same deduction saves you more. Here is the action step. Calculate your actual marginal rate. Most of you are between 12 and 24%. Once you know this number, you can make real decisions about whether deductions are worth it. Mistake number 4 is the one that separates the wealthy from everyone else. Most people have zero tax planning strategy. They just let the year happen, let the taxes accumulate, and then in April they pay whatever they owe. I know it feels that way. You are working, dealing with life, and then suddenly April arrives and boom, a bill. But here's the thing that wealthy people do differently. They plan. They plan a full year in advance. Do you know when the best time to reduce your taxes is? January, not December. Not December 30 with panic. January 1st with a plan. Here is what a real tax plan looks like. First, estimate what you will earn next year. Calculate what you will owe in taxes. Identify strategies that apply to your situation. Then execute those strategies throughout the year, not at the last minute. When you wait until December, you have limited options. You panic and make bad decisions. When you plan from January, you have the entire year to make smart decisions. For example, if you know you are going to be in a high tax bracket, you might increase retirement contributions every month. If you own a business, you might hire an accountant in January, not November. If you have investment income, you might structure your portfolio differently. All of these decisions take time. You cannot make them in December. So here is what you do today. Open up a spreadsheet. Estimate your income for next year, multiply by your tax rate. That is roughly what you will owe. Then reach out to a tax professional. Get a plan in place. Do not wait until December. Do it now. Now let us talk about mistake number 5, and this one ties everything together. You do not actually know your true costs. What do I mean by this? Most people focus on gross income and ignore their total expenses. They think, I make $100,000, so I am doing well. But then they spend $95,000 and save $5,000. That is a 5% savings rate. That is terrible. But here is where the tax habit makes this worse. They make these random tax-driven purchases throughout the year. They do not track their expenses properly, so they actually have no idea what their true costs are. Wealthy people do the opposite. They track every dollar. They know exactly what they spend on housing, transportation, food, entertainment, taxes. They know their total cost to the dollar. Why? Because you cannot improve what you do not measure. I have seen people save $10,000 on taxes but lose $50,000 because they did not track their actual business expenses. They missed deductions because they did not keep records. They overpaid on items because they did not track prices. They made duplicate purchases because they did not know what they already owned. Here is the habit you need to build. Every single transaction goes into a tracking system. I do not care if it is a spreadsheet, an app, or a fancy accounting software. Every single dollar in, every single dollar out gets tracked. Why? Because at the end of the month, you look at those numbers and you see your reality, not your fantasy, your actual spending. And when you see that reality, it triggers action. You stop the wasteful spending, you find the real deductions you actually missed. You optimize your true financial picture, not your tax picture, your actual financial picture. Mistake number 6 is the sneaky one that most people never recognize. You think that a big expense is an investment when it is actually just an expensive habit. Let me give you examples, and I guarantee you recognize yourself in at least one of these. You buy expensive coffee every single day. That is not an investment, it is a $2,000 annual expense. You buy the newest technology the day it comes out, not because you need it, but because it is new. That is not an investment, it is status spending. You go on expensive vacations every year, not because you have reached financial goals, but because everybody else is doing it. That is not an investment, it is comparison spending. I get it, we all want nice things, we all want to feel successful, but here's what the wealthy understand that you probably do not. Every dollar you spend on an expensive habit is a dollar that could have been invested. That dollar, if invested at 10% annual returns, would grow to $17 in 30 years. $17 from one coffee. So if you are buying that coffee 260 days a year, you are giving up $4,420 in lifetime wealth. For coffee, that is the real cost of expensive habits. Not what you pay today, but what you lose by not investing that money. Now, I am not saying you need to give up everything. I am saying you need to recognize the true cost. Cut your expensive habits by 50%, not 0%, 50%. Take that 50% and invest it. Within 10 years, you will have enough in that account to retire early. That is not a theory, that is math. So here is your action. Identify your top 3 expensive habits. Calculate what 50% would be. Commit to cutting it. Invest the difference. And finally, mistake number 7, the one that encompasses everything. Most people never actually learn the tax rules that apply to them. I know it sounds boring. Tax rules sound like punishment, like something the IRS created to keep you confused and poor. And you know what? They kind of did. But here is what most people miss. Once you understand the rules, they actually work in your favor. The wealthy have this advantage. They understand tax structures. They know about registered retirement accounts. They understand deductions that apply to their situation. They know capital gains treatment. They are not blindly filing their taxes. They are strategically using rules that exist to help them. And the best part? These rules are available to you too. You do not need a fancy accountant. You do not need a business degree. You just need to spend a few hours learning. But instead, most people avoid it. They think, oh, taxes are too complicated. I will just let someone else handle it. And then they wonder why they are poor. You are literally leaving tens of thousands of dollars on the table because you will not spend a Saturday afternoon learning basic tax rules. Here is what changes everything. Learn your tax situation. If you are an employee, understand deductions you qualify for. If you own a business, understand entity structure, depreciation, expense categories. If you have investments, understand capital gains and loss harvesting. These are not secrets, they are public rules. The IRS literally publishes them. So here is what you do. This week, spend 2 hours learning one aspect of tax law that applies to you. Just one, not taxes in general, something specific to your situation. Then implement it. Next month, learn something else. Within 12 months, you will have knowledge that saves you thousands of dollars every year for the rest of your life. That is the wealth building advantage that the wealthy have. Not genetic, not lucky, just knowledge. And that knowledge is available to you right now. So let me recap the 7 tax habits that are keeping you poor, and more importantly, how to break them. Number 1, stop letting the tax tail wag the dog. Make business decisions on business merits. The tax benefit is the cherry on top. Number 2, understand that a deduction only saves you your marginal rate. If you spend $1 to save 25 cents, you lose 75 cents. Do the math first. Number 3, never buy something just for a tax break. Ever. The ordinary and necessary test is real, and the IRS audits suspicious last-minute purchases. Number 4, calculate your actual marginal tax rate. Most of you are between 12 and 24%. This number drives every tax decision you make. Number 5, stop reactive tax planning. Plan on January 1st, not December 30th. You have 12 months to make smart decisions, not 12 days. Number 6, track every single dollar. You cannot improve what you do not measure. Once you know your real costs, everything changes. Number 7, cut your expensive habits by 50% and invest the difference. That 50% could grow to over $150,000 in 30 years. That is not motivation, that is mathematics. And number 8, the most important one, start learning your tax rules, not as punishment, as opportunity. Spend 2 hours this week learning one tax concept that applies to you. Within a year, that knowledge pays for itself 100 times over. These are not secrets, they are not illegal. They are not complicated. They are rules that exist to help you, and most people simply do not take the time to learn them. Now here's what I want you to do right now. If you found value in this, smash that subscribe button. I release strategies like this every single week, and you do not want to miss them. Second, share this video with one person who you know is struggling financially. I guarantee someone in your life is making at least 3 of these 7 mistakes. By sharing this video, you might save them $20,000. That is not hyperbole, that is actual money. Third, comment below which tax habit was the biggest realization for you. Was it not understanding your marginal rate? Was it the expensive habits adding up? Was it realizing you have 0 tax plan? I read every comment, and I love seeing these breakthroughs. And fourth, if taxes stress you out, you are not alone. Most people feel this way because they were never taught the rules. But now you know where to start. Pick one tax concept this week, learn it, implement it, feel the difference. The wealth gap between rich and poor people is not because wealthy people are smarter, it is not because they are luckier, it is because they know these rules and they use them. And now you do too. Thank you so much for watching. I will see you in the next video.